Bitcoin is something I have not talked about in a while here on the channel, but right now it's setting up both fundamentally and technically for what could be a major move to the upside. So in this video, I'm going to break down the chart of Bitcoin, what I'm seeing, and the reason I'm looking for potential buy trades right now. Also, I'll explain why I think you probably should not be looking for buy trades on Bitcoin. And I know that might sound confusing right now, but I promise it'll all make sense as long as you stick around through the intro and disclaimer, and I'll be right back to break down Bitcoin and explain why I'm looking for buy trades right now. Welcome back, and just in case you're brand new, my name is Steven. I've been trading for over a decade, and I've been teaching traders just like you from around the world for a little over 6 years now. Let's look at Bitcoin. Before we even take a look at the charts, let's break down the fundamental catalyst that I was referring to at the intro of this video. And unless you've been living under a rock, which if you have, no judgment, bro. But unless that's the case, you probably know that the USD, the dollar, has been experiencing some stress lately. Let's just call it like that. And what happens whenever the USD experiences some type of stress is that investors try to find a different asset to hold their wealth. So Bitcoin could be one of those different assets that investors turn to in order to hold wealth while the dollar continues to undergo a stressful environment. And if that's the case, that is definitely a catalyst that could push Bitcoin into a meteoric rise to the upside. So that is the catalyst from a fundamental standpoint. Now, outside of that, we also have a great technical bias here on this trade as well. I'll explain that now. So here on the charts, what we have is Bitcoin holding this range towards its most recent highs, and that is a good sign. And an even better sign now, after we've created this resistance level that we've tested multiple times, and we now have an even better catalyst from a technical standpoint because prices have put in a higher low. What I mean by that is prices were holding this range down here around the $27,000 range. And at this point, it seems as though buyers have stepped in even higher up here towards the 27,775 range, 27,750 range. And with that being the case, we have higher lows, which means buyers are coming in at a higher price. And that can also lead to more buying pressure, which could cause a breakout of this ascending wedge. So this ascending wedge right here is giving me a nice bias from a technical standpoint, along with the bias I have and the catalyst I have from a fundamental standpoint, which in my opinion can create some of the greatest trading opportunities that I personally have ever had. Now, the purpose of this video in no way is to get you to buy Bitcoin. A majority of you should probably not be buying Bitcoin. And now what I want to do is talk about why. Let me preface this. I am not referring to buy and hold strategies or long-term investing. I'm strictly speaking to swing and day trading with this example. But the reason you should not be buying Bitcoin from a swing or day trading perspective, or probably any other asset right now, is because if you are anything like I was at the beginning of my trading career, you're probably terrible at trading psychology, and you probably don't have a great handle on risk management. You're probably moving your stop loss a lot, getting really emotional in trades, exiting trades early or late, depending on which direction the market's going. You're probably doing all of those things and making all of those mistakes, and making those mistakes is a recipe for disaster inside of a trading account. Now, trust me, I know the feeling. At the beginning of my trading career, I was just looking for the next big trade I could put my life savings on and hopefully get rich overnight. But my friends, that is not trading. That is just another form of gambling. That's like going to the casino and putting all your money on black at the craps table and just hoping that it wins. And here is the reality of trading. In any asset, on any market, I have no idea what Bitcoin's going to do. I can make a prediction based on a fundamental catalyst and based on a bit of a technical catalyst that I have in this ascending wedge. But in reality, I have no way of knowing 100% that prices are going to go up. And no one does. So what I mean by that is that this trade could very well lose. And this is what trading is. I am going to risk a very small portion of my overall account because I know I have a chance of Bitcoin making a meteoric rise to the upside. And I'm risking an amount of my account, which will probably be about 2%, in order to involve myself in the market, put money at risk. What that means is I literally know this could possibly lose. And I'm making myself comfortable with that fact that the market could go down and not up, and that I could be completely wrong by using good risk management and only risking a very small portion of my overall account value. So what trading is, in reality, is not placing your life savings on the line and hoping you get rich overnight. That's gambling. Do whatever you want to with your money. Obviously, I would not suggest that. Trading is understanding that there is a risk involved of you losing a specific trade, making yourself comfortable with that risk by using good risk management and trying to spot opportunities that give you the best odds of a very large gain on your account, which is exactly what I've done with this trade. And the main point of this video, again, is not me saying go buy Bitcoin. A majority of you probably shouldn't. Do whatever you want to with your money, but do not buy Bitcoin just because you watched this video. None of your trading decisions should be because of someone you've watched on YouTube. They should come down to your own personal experience and skill. And if you're sitting there going, but Steven, I don't have the skill yet, then you should not be trading with real money. You should learn the skill first. So what I want to do right now is help you understand the skill of risk management. So let's break down the 3 components of a good risk management plan and how you can implement them to improve your trading psychology and reduce your chances of losing more money than you want to lose on any specific trade. So the very first thing you'll need in order to implement a good risk management plan is a stop loss on every trade that you place. Without a stop loss, you don't have a really good way of gauging the amount of money you stand to lose on a trade, which is semi the definition of risk management. If you're managing risk, you need to know how much risk you have on the table. And a stop loss is how we determine that amount of risk. So let me explain a stop loss to you right now. A stop loss essentially is just you telling your broker, I want to get out at a specific level. Here on Bitcoin, my stop loss is right here. And I'm going to explain why. You always want your stop loss to be at a place where you know you're wrong. So in this case, why is my stop loss right below this swing low? Well, the reason is that I know right now I have a good chance of a breakout happening because prices are making higher lows. If that does not continue to be the case, then the chances of a successful breakout go down dramatically. So if we get a lower low than this low, the chances of this breakout happening that I'm looking forward to, the chances of the breakout I've predicted coming true, go down dramatically if we get a lower low. For that reason, I'm telling my broker, get me out of the trade right here. This is a stop loss. This is where I want to go ahead and get out of the trade. I don't want to lose any more money. And my initial bias, the initial trade that I had planned to take, is no longer giving me the positive expectancy that I predicted it would. So that was a really long way of just saying your stop loss is an area in the market where you're going to get out of the trade for a loss because your trade no longer makes sense. And that's the first step. The next step is to understand position sizing. Now, position sizing essentially means if this is the place my stop loss is, how much Bitcoin do I need to buy to have this stop loss equal a certain amount of my account value? And we have an entire video on leverage and position sizing that I'll put in the top right hand corner because that is a very long conversation. I don't have time for it in this video. Hopefully you already know a bit about position sizing because that is a very beginner topic that you should probably know by now unless you're brand new. But let's move on to the 3 pillars of a great risk management plan. You know now that you need a stop loss. And what we're going to do is I'm going to draw out a triangle. If you've been a part of the channel for a while, you know that I love shapes. Triangle is one of my favorite ones. In the middle of this triangle is when you have mastered your risk management. Now, the first step of doing so is determining something called risk capital. Risk capital refers to the amount of your net worth that you're willing to put into a speculative trading account. I mean, swing and day trading on assets like Forex or crypto or even stocks, that would all be considered speculative trading. And the harsh truth is we have seen companies like FTX go down completely, meaning a lot of people who had accounts there lost their entire account value. So this is a very important rule to follow because as we've all seen, and I'm sorry for anyone who actually fell under that unfortunate event, but as we've all had to learn the hard way, brokerages can be shut down and can go bankrupt, and you could lose literally all you have in a trading account. So risk capital is a way to protect yourself from that. Risk capital means an amount of your net worth that you're willing to put into a trading account. So let's say there's a person with $10,000. This is their entire life savings. This would be their net worth on a cash basis. They may decide to only put 20% of that into a trading account because that's what they're comfortable with. Another harsh truth is that if you're a beginner or a struggling trader, the very likely scenario is that you will lose some or all of your initial account. And with that being the case, you definitely don't want to start an account with your entire life savings. So risk capital, again, refers to an amount of money that you are willing to put into a speculative trading account. Just to give you an example of this, it can go up and down. Whenever I first started, this amount was much smaller, but now I have well over 70% of my overall net worth in a brokerage account of some kind, whether that be long-term investments or swing and day trading accounts. Now, there is no way for anyone to tell you what this amount should be for you. The point of this is for you to put an amount that you are comfortable with in this account. That's the first step of having a great risk management plan. Let's move on to number two. Number two is something we call risk per trade. Now, what this refers to is an amount of money that you are willing literally to risk on each trade that you place. And as a beginner, what I would have done is I would have picked one number. So for me, I risk a certain percentage of my overall account value. And for me, it's normally between 1% and 2% of my overall account value. It's almost never under 1% and almost never over 2%. So my rule for risk per trade is between 1% and 2% per trade. Now, that in no way is a suggestion of what you should risk. Your risk management plan, the entirety of it, has to be something you're comfortable with. Maybe you have less risk tolerance than me, and you need to risk something between like 0.5% to 1%. Maybe you have more risk tolerance than me, and you're willing to risk up to like 3 or 4%. Again, the point of this is not for you to copy any one trader that you've ever heard on YouTube. The point of your risk management plan is to keep you comfortable in trades. So what you need to do is think of a number that would keep you comfortable in a trade if you started to lose it. Because what happens when we're risking too much per trade is we'll start to see that trade drop, right? You buy in and then we see it drop. And you had a stop loss here, but it's dropping and you go, oh, it's got to go back up eventually. Let's move our stop loss down even lower because you're uncomfortable accepting the initial loss. And then that leads to more losses. I have seen so many traders who have blown accounts strictly because of that. So to avoid that, you need to work on your risk per trade and find a number you're comfortable with. Third and lastly, the last pillar of a great risk management plan is going to be overall risk exposure. Now, in a very simple way, this is nothing more than how many trades can you be in at one given time. And to give you an example of this, my overall risk exposure that I am comfortable with is 10% of my overall trading account. So what I would do is if I'm risking 2% per trade, to keep math simple, that means I can be in 5 trades at once. That is my overall exposure. The reason for this rule is because it happens very not often. Rarely, that's the word I was looking for. It happens very rarely, but you may have a situation where you're in multiple trades and some kind of weird news event comes out. And then prices spike up and down like crazy, and you end up losing all the trades you're in all at once. So what if you had 10 trades in and you lost 20, 30, 40% of your account in a matter of an hour, in the matter of a day? That would be a hard hit and very difficult to continue trading without becoming emotional after a hit like that. So for that reason, my overall risk exposure is 5 trades, which puts me at risk of about 10% of my overall account value, which is something I am personally comfortable with. Again, just like everything else, this needs to be a number you're comfortable with. So in order to master your risk management, what you need to do is sit down and literally just sit there for 30 minutes and think about what you're willing to risk in speculative trading. You need to think about a number you're comfortable putting into a trading account, knowing that beginner and struggling traders lose some or all of their initial investment. 95% of them lose some or all of their initial investment. Think about that when you're deciding on risk capital. You need to decide on a number for yourself in terms of risk per trade. Sit down and imagine a trade going against you, getting close to your stop loss. What number, how much of your account does that risk, does that stop loss need to have at it, need to be? How much money could you lose comfortably? Because if you're uncomfortable with that loss, you put yourself in a position where you might move your stop loss down, lose even more money, even more money, even more money, or even blow an entire account. So sit down and think of a number that you're comfortable with in terms of risk per trade. And finally, during this 30-minute meditation session you do while thinking about risk, think about your overall risk exposure. How much money would you be comfortable with losing in one single day, in one single hour? As your overall exposure in the market, what are you willing to have exposed at one given time? And how much of your account can you lose and still continue trading the same trading plan, still continue to trade without letting your emotions take control? And if you do all three of these, I promise your risk management will be better than 95% of traders, and you will have a much better handle on your trading psychology and on your trading mindset. So now you know more about how to master your own risk management. Complete transparency, I have now already bought Bitcoin. My stop loss is exactly where you see it. This target is not my target. It's more like an initial place. I may take off some of my position, but again, complete transparency, there will probably be somewhere around 100,000 people see this video. You'll either see me lose it or win it. I have no way of knowing, but either way, I am not going to be upset. I won't be upset because people see me lose a trade if it wins. I won't be ecstatic because you see me win a trade. And the reason I won't be upset about the loss is because why? Is because I'm using good risk management. This loss will be a very small portion of my account balance, and I will probably still go out to a nice dinner with my girlfriend, laugh, smile, and have a great time, even if I lose this trade. So with that said, keep a good handle on your risk management. And if you're currently struggling to learn how to trade and you want some more advanced training, we do have some space available in the TTC Forex University. If you want to know all the details about that, all you got to do is click the link in the description. It's going to be the top link, or go to www.ttcfxuniversity.com and you can learn all about our new flagship program. If you're not interested in that, that is completely fine too. Just make sure you are subscribed here to keep up to date with all the content we release. Make sure to click that like button if you made it to the end. Go ahead and comment if you made it to the end as well. I hope you have a great rest of your day. Trade green, and I'll talk to you in the next video. See you soon.